So welcome to a first. I'm doing a screencast, and it's because I'm getting very frustrated with hearing a lot of commentary about the USO, and I want to explain it, and I figured it'd be easier to do it just like this. Now, I'm new to these, and I'm sorry if I waffle on, and I've got some notes, so occasionally I'll be reading from them. You've got to forgive me. I've also got some water, because it turns out that talking to yourself is very parch-inducing. So, with that disclosure settled, I will crack on. So, what's been going on? USO, and what is the USO? So, the USO is a fund, an ETF. It's based out of the US and it tracks WTI, specifically invests in the front month future of WTI. And in recent weeks, its assets under management have absolutely exploded, and everyone is saying, wow, retail investors are really smart, because they're obviously picking the bottom. Now, is that really the case, or is there something more complex going on? I'm going to suggest that there is possibly something more complex. But before I do that, I just thought I'd show this slide. It comes from Helen Thomas, who writes the Blonde Money note, and she has been looking at ETFs for a while, and she observes, as I do, that ETFs often, in terms of their AUM, often sort of operate in a very counter-cyclical way. So the AUM tends to grow as the market bottoms, and vice versa, which possibly implies that ETF investors are super smart at picking bottoms, because usually the growth in the fund really preempts the bottom coming about. That may be the case, but it's certainly an interesting phenomenon. Now, a few other things about ETFs that are often overlooked by people talking about them. So people perceive them as being very retail focused, when in reality that's not the case anymore. Institutions and hedge funds are really among the biggest users of ETFs. The other dirty little secret that ETFs have is that they are often much more in demand by hedge funds for shorting purposes than for going long. So the market makers in question lend these out a lot of the time, and they use a special thing called create to lend, but I will explain that in a little bit more. But all in all, there's a complex arbitrage mechanism at play, which can have potentially distorting impacts in the long run when the funds are invested in things like derivatives. So going back to the oil, to the USO, this is not the first time something strange has happened in it. Back in 2008, 2009, the fund also started to explode. I wrote about it back then, and the first post I wrote was called The United States Oil Fund Mystery, because it was really growing exponentially at a time when nobody was really very bullish to the market. And again, the same conversation was being had: is it the case that these retail investors are super smart? And now we're seeing a similar conversation. The fund AUM is exploding, and people want to know what's driving it, and is it really the case that people are piling into it? So back then in 2009, I followed the work of Olivia Jacob at Matrix, and he was very good at sort of tracking the disproportional sort of growth. That's how it was back then. And this, just in context, is what has happened since. So there was another time when it exploded, which was in 2014, 2015, when the oil price really cratered. And so again, perfect example of how counter-cyclical the growth is with the market falling, which is kind of indicative of a really smart investor. And now it's exploding again. So where are we now? Excuse me whilst I look at my notes. So just quickly, in terms of how it operates, it invests in futures rather than stocks. Now, this poses an issue, because any fund ETF that is invested in futures is exposed to the curve structure of the futures market. And this is essentially the fact that because futures have different expiries, as you move forward, they can either be trading at a premium or at a discount to the front end future. When the futures contracts further down the curve, are at a premium, you have a contango structure in the market, and when they are lower than the ones today, you have a backwardation. Backwardation is usually a sign that the market's very tight, and there's a lot of demand for oil today, and contango is the opposite. There's usually a glut in the market, and people there's almost no demand for it today, but there might be tomorrow. Now, that has a big implication for funds, because if they sit in the front month, when that front month contract expires, they have to buy the next month. And if the next month is always more expensive, well, somewhere the money has to come from to fund the differential. And usually that comes out of the AUM. And this has an impact on the performance of the fund, especially relative to the overall index that it's tracking, i.e. the WTI front month. So here is an example, very quickly, of how that leads to underperformance. And so the white line here is the USO, and the orange line is the WTI contract. And you see it doesn't track very well at all. In fact, you think, well, if an ETF is supposed to track WTI, what's this that I'm invested into? And that is the impact of the rolls. So whenever there's a contango in the market, you get a massive underperformance. And when you have a bit of a backwardation, as you did here, then you get a contraction in terms of the underperformance. You recoup some of those losses, because you then make money in the roll rather than lose money. And so you see how that has fluctuated over time. Now, currently we're in a bit of a strange situation, because in theory there is a contango, and yet there's been supposedly a sort of a closure of some of the losses, but that is a very special situation, because we haven't had enough expiries yet to really hit the rolls, but also the proportional cost of the rolls is lower, because the numbers now are much smaller than they were back in 2008, because we're sitting in negative prices in WTI, and and that is going to have an impact. Excuse me. So, where are we now? Excuse me whilst I look at my notes. So, just for an example, here's how the contango played out over time. So this is the 2008. This was a very sharp contango here, and now we're approaching sort of near 2008 levels. These charts were done at the weekend, so that things have slightly changed since I last did them. I think we're now matching 2008, if not exceeding. And I threw in the DFL, which is the difference between the front month and the physical price, because at the time this was I think more deep than the contango on the derivatives. I haven't got the 2008 equivalent because I ran out of data, but I was told that it was either steeper or as bad as 2008, whereas this one wasn't. But I think that's changed now. I think we're basically at 2008 levels now. But here's just another way of showing you the counter-cyclicality. So this is the growth in the fund's assets, and this is how it nicely simulates, the bottoms. So the peaks are very much in line with the bottoms. You see. So that explains that. So now we are at the USO's sort of structural specifics. I want to talk about, okay, so it's important to understand that the ETF manager in general is a neutral entity. So people kind of blaming them for what's going on, it's not really correct. They have a mandate, they stick by that mandate. And there is an exception with derivative funds, because usually all the buying and selling in the market is not done by the funds. It is done by the authorized participants, who are specifically charged with creations and redemptions for the fund. So all the market activity is usually done by those guys. They're very specific entities. Now, in the case of a derivative fund, because they still have to manage the rolls, the fund does operate in the market via proxy or agent, but that is just to manage the existing positions. And so that has an impact, but only on the underlying, not in terms of the ETF trades themselves. Got it? So in the case of the USO, they have 15 authorized participants, and as I mentioned, these are the people, the entities that are specifically only they are able to create and redeem ETFs from the fund. The lead manager is Virtu Financial, which is a well-known HFT kind of ETF trading market maker, interestingly, even though it's the lead, when you look at the 13F filings, you'll find that it's not actually anywhere on that list. It's the list at the moment is topped by an outfit called XR Securities, which is some company related to XR trading. I've never heard of them before today, but they're not an AP, so they might just be someone who's kind of speculatively come into the market because they're seeing some opportunity, or maybe just market making on the side, or maybe they've stepped in because the others have pulled out. The other top ones tend to be the other APs, but Virtue's not on there, and that's not surprising because Virtue's not a bank, so it might not have the balance sheet to support any inventories or directional trades. It'll be just a neutral entity buying and selling only when it has an opportunity to benefit from an arbitrage and closing out those positions and ending the day neutrally as much as possible, and it hasn't got any positions outstanding according to the filings. Now, very quickly on ETF arbitrage. It's fairly simple. So how does the fund track the underlying? Well, it depends on these APs, and they are incentivized to act whenever there is a distortion, whenever there's a dislocation of the ETF price versus the underlying or the indicative net asset value of a single unit of ETF fund equivalent, right? So when the ETF is underpriced, let me figure out which handle I'm going to use. I'll use this one to be the ETF. So when the ETF is underpriced and the underlying derivatives are overpriced, the AP has an incentive to come in and buy that ETF and deliver them to the issuer ETF manager, and they will redeem derivatives from that fund, which they then sell into the market. So the act of selling the derivatives brings the price down of those, theoretically, and it brings the ETF up. And they do it until the two are brought back into whack. And that is how the fund arbitrage happens. The other way around, if the ETF is overpriced relative to the underlying, then the AP has an incentive to buy the underlying and deliver it to the fund and get the ETF, which it then sells into the market, bringing it back into line. And that is how that arbitrage works. Now, throughout the day, there is a premium or a discount relative. Now, but what really matters is whether the fund at the end of the day closes on a premium or a discount, because if it does, it implies there was something impeding that arbitrage. So a lot of people watch the premium and discount as a sort of symptom of market stress, and certainly it is indicative of market stress. Here's the premium discount, the TLT recently, which is a ETF which tracks high yielding bonds, corporate bonds, and you'll see this is the deviations on the premium and discounts in March. And you can see that there was obviously something impacting the ability to arbitrage, whether that was creditworthiness, funding, or other operational issues. Something was happening. But it's not just like TLT, which you might expect to have issues because of the liquidity of the underlying. The SPY, the famous SPDR massive ETF, which tracks the S&P 500, also had a lot of issues in March. In comparison, the USO did not do badly. This is the long-term premium discount sort of deviations on USO, and you'll see that by and large, 2008 had a wobble. You had a bit of a wobble during the big sell-off in 2014-15, and you had a wobble more recently. And this has tended to the situation where there is a premium in the ETF at the end of the day rather than a discount. So someone's not closing that arbitrage for some reason. And this is the shorter term picture, and you can see again the same situation. But it's also important to understand, excuse me, it's time for a sip of water, I think. Quickly. So it's also important to understand why certain strange things happen. So shares outstanding in the USO, for example, are growing far more quickly than the assets under management, which is weird because you would think there would be a share for every there would be an equivalent increase in shares outstanding to AUM. Now there are certain things that logically and fairly impact the rate of growth of shares outstanding relative to AUM. One of them is essentially the fact that the AUM will be impacted by the fees that have to be paid out, and of course the roll costs they eat into the underlying. And that makes it look like there are more shares than there are AUM. And here it is indexed, so you can see the shares outstanding are growing more quickly than the assets under management. But then there might be another reason why shares outstanding are growing more quickly, and it may be that the ETFs are benefiting from their very unique situation, which allows them to defer settlement for a long time in terms of the underlying. So shares can be created and the delivery of the underlying can be in theory pledged, but it's not actually settled sometimes for a long time. Not saying this is necessarily the case with the USO, but it is definitely the case that ETFs have had these issues in the past. So there has been long-term concern over institutional naked short selling, and this is sort of justified in the market because of the way the market makers operate. But it does lead to a situation where you have a lot of short interest, effectively encouraging fails to deliver by the APs or market makers in these products. And back when I was covering it in 2009-2010, we were looking at the ETF settlement issue, and some of these funds, even though they're supposed to settle the T+2, they were not settling for days and days and days, which equates to effectively free funding for some of their positions. Don't know if this is the case now because I found it quite hard to find the data, so if anyone knows where I could find the data, please tell me. But there's also another issue, which is that at the time, some research showed that there's also this creation of phantom ETFs, and they wouldn't necessarily show up in the shares outstanding, but maybe are a function of something called the create to lend mechanism. What does that mean? So, when they tallied up all the 13F filings in terms of how many funds said they had positions in X, Y, or Z fund, it turned out that those massively outnumbered, well not massively, but by some proportion from the actual shares outstanding. So there was some element of shares that were double, two people effectively own the same share in some cases. It's a sort of fractional reserving of the fund. So what causes that? Well, create to lend might be one factor, and whether it's impacting USO or not, we don't know. I'm going to talk to some people later on this week, maybe I'll find out more, but it's definitely worth considering how it works. So what is create to lend? Now, when a hedge fund wants to borrow stock, you'd think, well, why would it borrow USO? It could just easily take a position out in the futures. Which would be quite simple and liquid and blah blah blah. Why go to the effort of shorting USO? Well, there could be a financial incentive to do so. Borrowing stock of the USO might be cheaper than funding a margin position at a futures exchange, and there may be other tracking sort of benefits. You might actually be wanting the specific performance of that fund rather than you might be hedging the derivatives or something like that. So there may be specific reasons why you want to do that. And by and large, it's also easy. You know who to go to. So you know that there's an AP stroke or custodian of that AP who will create you specifically some shares which they will lend to you for you to sell in the market. And this is what create to lend is. Now, if that create to lend function happens in a balanced market where the ETF is priced, according to the indicative NAV value of its underlying, then the whole function has a sort of incentive to create a sort of naked shorting situation that is a wash in the long run, and that's why it's justifiable naked shorting. So the AP creates a share that they immediately lend to the hedge fund, but they have like as much as T plus 2 to deliver the underlying derivatives to the fund. The hedgie sells the fund immediately in the balanced market, and that creates a discount, which, as per the arbitrage mechanism, creates an incentive for the very same AP to come in and buy the ETF and pledge it in return for the derivatives. Now, if you consider that they still owe the fund the derivatives, rather than going through the motion of buying the ETF back and then pledging it and getting the derivatives, they just don't send the derivatives in the first place. The whole thing is a wash. And what you end up with is a situation where nothing really changes in terms of assets under management or in terms of shares outstanding, but you have an additional share obligation out there because the hedge fund obviously has borrowed and sold into the market, and that's how that works, and sold it to somebody. However, it gets interesting if the market is not balanced. So if in a market where the ETF is overpriced, so this is the ETF, it's overpriced, the indicative net value, the hedge fund receives this created share, it sells it, and that brings the market to equilibrium with the underlying. By this point, the arbitrageur, the AP, has no incentive to buy the ETF. So in reality, what they do have an incentive to do instead is, well, not an incentive, they basically have to fund or settle the position. So they have to actually deliver the derivatives to the fund within 2 days, unless in the interim something happens that makes them close that position before they have to do it. But as I said before, a lot of them don't want to be taking a position, so they would rather square things off as soon as possible. But what does that do to the fund? In a nutshell, the shorting demand drives growth of the fund, because through that shorting mechanism, the AP is effectively creating shares. However, there are some things that you have to be mindful of. Even though it's therefore tempting to say that the create-to-lend function could be the driver of a lot of the growth, and as a result it's shorting interest that is driving it, someone still has to buy that shorted share in the market. So there is going to be some amount of dumb money or smart money out there that is buying the hedge fund, being the opposite of the hedge fund short. Now, it's potentially the case if this is happening in an imbalanced market where the ETF is overpriced, that it's a retail investor who is buying an overpriced ETF relative to the underlying because he doesn't know better. In which case, it's not so much smart money; it's that he's a bit late to the game. But the way it all works out is that the fund grows, and he's essentially funding it indirectly through his trade. So it's not fair to say basically it's just shorting demand that is driving it, because essentially there has to be a buyer. Nonetheless, it can be the spark that creates the vicious circle that then leads to the exponential kind of growth of the fund in the short term. Because it's important to remember that in that scenario where the AP has to deliver the shares, somebody has to fund that position. And who has the incentive to do that? Because it's going to be expensive. And the more volatile the market is, the more expensive it is. So usually hedge fund fees are, short fees are, for borrowing stock, are a reflection of how easy it is to create to lend, and the fact that by and large an AP can do it without having to take a position in the market because it's an imbalanced market. Now, when things get volatile, especially when the ETF, there's a premium in the ETF, as per before, then there is, less of an incentive to do this, and so the borrow rates go up. And this is what's been happening recently, is that the borrow rates have been going up. So people aren't necessarily incentivized to lend ETFs. But perhaps there is an exception where it does pay to do it. So who could fund that sort of position? Well, it would be definitely not an AP that doesn't have access to lender of last resort, because in that sort of in the current scenario, it's clear that a bank would be preferable because they have a lower cost of funding versus a non-bank. But it could also be someone who's wanting to take a directional bet. So if you know that your create to lend function will encourage the fund to grow, and you know that will have an impact on the derivatives that are underlying it, because it will lead to a cascading situation where people see the fund growing and then start to try and front run it as the contango, and the contango essentially gets exasperated more and more as the whole thing goes. You can pre-position yourself to benefit from that, and therefore you have a kind of incentive to keep lending for the shorts who want to short it, because you're taking an offsetting position that's making you a lot of money. And then, and if the cost of managing that position is lower than your potential expected profit, it could be worthwhile. And you always have the capacity to close that as a, and kind of eliminate your position as an AP anyway, on a preferential basis, because you're the only one that can redeem or create. Excuse me for the typo, it says viscous, it should say vicious. So where does that lead us to? It leads us to a sort of self-propelled, vicious circle. And what are the consequences of this, and why is it important? This is really what we're talking about, why we're talking about it. Well, it's important because as the fund grows bigger, it potentially distorts the market more and more and more, and it has an impact in terms of the delivery, in terms of the expiry of the funds. Now, it's also already the case that post-2009 there was a big review in terms of how big some of the positions can get, and the CFTC imposed certain position limits, and especially in the very front month contract that was going to immediate expiry. So for example, this today's Monday, Monday 20th of April, the front month WTI contract has gone negative. It goes into expiry tomorrow. The USO will not have been invested in that contract. It was already in the next contract, in the June one. And nonetheless, it will already be being anticipated that it has to roll. And this is what's happened recently, is that as the fund has grown, it has faced a constraint in terms of how much it can hold in that front month due to position limits and just generally being front run. So it has put out information that is moving its positions to not just the front month but over the next month as well, which is contrary to its mandate. There might be some terms and conditions that preempted it and envisioned it, but certainly it's not what people expected. In 2009, it also took offsetting action because it ended up moving into swaps, and it also took out a big total return swap with a specific bank to compensate and to make it to offset the need to go into futures. In this case, now it also sits in ICE futures, not just the CME futures. So it's spreading itself around. There's now been another regulatory release that says the demand is so big, and it could be again through shorting, who knows, that they are now issuing even more shares. But of course the whole thing becomes like a feedback loop, because when people think that people are moving into WTO because they think USO because it's bottomed, it'll encourage even more people to do it, and that creates even more of a growth issue, and then the whole feedback loop becomes more and more exceptional. Now, will this time be different? This is the question. Now, if we look back to the previous years that the fund exploded, it was really good at timing that bottom. So will this be the bottom, or will these investors be proven to be sort of more on the Muppet end of investment? We are yet to see. Certainly we will be watching. There may be at this time a different situation, in so much as people may not have been expecting that the WTI contract could go beyond zero. And today, the fact that the front month went into negative territory might be an indicator that these recent investors in the WTO still bear a lot more pain before they start to see a bottom. So that could be the reason this time is different, but then again, maybe it's not. Maybe this will be the zero bound beyond which we spring back from. Certainly what we will be watching is how people are positioning themselves as this fund grows, and what action the fund will be taking to minimise its footprint. Interesting times, to say the least. I hope this has been informative, and I will try and follow up with some posts as and when things proceed.